So what'd you think? What'd you think of that and the wage number and some of the revisions?
Well, stocks are volatile. The job market isn't. This was very much in line with what we're looking for. You're a little bit weak in the payroll number, 155. It might be nicer if it was a little higher than that. But the unemployment rate, you take it out to an extra tenth, it did hit a new, 49-year low. Labor market's tightening. I mean, what's going on here is the economy is shifting down from third gear down to second gear. Everybody should be calm about this. I think people are getting nervous about it, but that's really what's going on here.
Diane, of course, we can't not mention the call you had this week that you do expect the Fed to begin cutting by the end of 19.
After they raise rates. So I still have a December rate hike and 2 rate hikes next year. But I think David is right. We are starting to shift down in growth. We know that the fourth quarter is going to be weaker, and we're moving into a year that's going to be weaker. That's not too weak to start with, but at the end of the year, we have a lot more headwinds, and we could change that. We could get more tailwinds if we get some change in the trade situation and the tariff situation. But right now, we're starting to see the corrosive effects of trade creep into the numbers, and we're also seeing some of the issues going on in the auto sector. Vehicle production was down a bit. That'll be down even more as we go into the year because of the allocation of cars versus trucks and the need to get rid of a lot of car production instead of SUV production in the U.S.
Diane, if you think the Fed goes up in rates initially and then by the end of next year it's going to be lowering them, so we're spending no time at neutral. Is that what you're basically saying? we essentially kind of quickly realize that we've gone too far?
It's not necessarily we've gone too far. It's just that the economy has some fragilities to it and fault lines. I think there's some breaks in the foundation, and we're not patching them up right now. So the cracks are getting larger rather than smaller. They could be patched up with a change in policy, but right now policy has not changed. Actions speak louder than words. And what we've seen is, although the administration is trying to move forward on trade agreements, they have not backed off on any of the tariffs they've levied so far, even though they've come to tentative agreements with some of our closest trading partners. So I think that's the things that we're the most concerned about, and the spillover effects of that, of weakness in China, what that means on knockoff effects. It's not the direct effects of the tariffs, but it's all the contagion effects and all the collateral damage of a weaker China, which is the second largest economy in the world with tentacles in most developing and developed economies.
David, isn't this the kind of number you'd want if you were bullish on the stock market?
Yeah, it is, and I think it's very important that everybody keeps their nerve here, including the Federal Reserve. I mean, I think the Federal Reserve should absolutely raise rates in December. They should raise in March and in June. I hope actually they stay at neutral, because the problem is the moment the Federal Reserve panics here, everybody's going to panic. And so while I get it that the economy will grow more slowly next year, there wouldn't actually be any problem with having a slightly lower federal funds rate by the end of next year. I don't think the Fed should do it. I think the Fed should move to neutral, stay there, and just try and let this expansion coast for as long as it can.
I'm thinking back a couple of years ago, you wish they had gotten an earlier start.
Absolutely, because the problem is that the Federal Reserve is like a knight with one sword and two dragons, and the inflation dragon's not a problem, but the asset price dragon really is. Asset prices across the whole economy have been gradually moving up for years, and the problem is if you let that get out of hand, eventually it bursts, and it's pretty ugly scene. So the Federal Reserve needs to get to neutral in order to hold asset prices from going up too quickly.
Yeah, that's straight out of Marty Feldstein's op-ed piece the other day, Diane.
Well, I just wanted to also add the one issue the Fed is watching very closely is corporate debt. And corporate debt has gone up quite a bit. And by the end of this year, I do expect the Fed will do the December rate hike. That's a doubling of interest rates in a year. They're still low, but that interest expense is going up. And I think that's where the Fed is starting to look for some of these tipping points that might not be what they once thought would be at a neutral rate. So some things in the economy we've extended and pretended in many aspects of the corporate sector. And when we should have been restructuring earlier in the cycle when we could have absorbed it, a lot of it is going to be pushed out to when rate hikes are only a little bit higher, and I think that's one of the concerns that the Fed has, and it's certainly one of the concerns that I have going forward.
David, I guess the way that the corporate sector in general also sort of reorients itself is interesting here. You're starting to hear a lot more about balance sheet repair. We're going to be careful about how much we do in buybacks and how much more debt. Do you see anything that's actually more of a pronounced shift in that direction, and could that draw more from next year's growth?
Not too much. I mean, when I look at the, if I look at the behavior of the corporate sector, when I look at investment spending overall, it still looks like it's on a reasonable track here. This economy has basically been a tortoise for a long time. A sugar high in 2018, but now reverting to its tortoise-like character. I would like if the Fed had started earlier, because I'd much rather they were tightening into a 3% economy than tightening into a 2% economy. But better late than never. They don't, a lot of bad behavior is encouraged by a zero real rate, and they need to move that real rate to positive.
David, what about the bond market? I don't want to set you up to disagree, you may not, with your chairman and CEO, who yesterday told us, Jamie Dimon I'm talking about, if there's a bubble anywhere, it would be in government bonds. We're way too suppressed now for the better part of 8 years. We have to sell 1.8 trillion of bonds, 1.2 trillion to finance a deficit, another 600 coming off the Fed's balance sheet. Does that pressure prices?
Well, I think yields will go up. I mean, I think the big thing that pushes up yields at the long end is the short end. So I think that we could be at 350 by the middle of the year. Beyond that, there's just a huge global demand for fixed income also, which I think helps hold these rates in check. And the one other thing that I think is very important is we're not seeing enough wage inflation to cause a general inflation. I think a year from now, we're still going to be looking at a 2% personal consumption deflator year over year without any breakout to the upside on inflation. I don't really see 4%, 5% yields on 10-year treasuries.
Diane, Jamie Dimon says, I honestly believe the 10-year should be at 4% already. You agree with him?
Well, I used to work for Jamie too, so I don't know that it should be at 4% already, but there's no question that the Fed's quantitative easing program pulled out a lot of that high end. It put a ceiling on those long-term rates, and we are now lifting that. And it'll be interesting to see how the Fed maneuvers a slowing economy and its balance sheet. I think that's one of the questions they're starting to look at, along with how do they deal with short-term interest rates, get flexibility in general. But this sort of autopilot on the balance sheet may have to be revisited as we get to the end of the year. And although I agree with David, there has been a strong demand from foreigners for U.S. Treasury bonds. The largest buyers of U.S. Treasury bonds are the Federal Reserve and Social Security. The Social Security Trust Fund is shrinking, and on the other side of it, the Fed's balance sheet is shrinking. You need to fill up that gap, and you're adding a lot to it. At the same time that China has rotated out and Japan's picked up the slack, I don't see China being the big buyer of U.S. Treasury bonds that they once were, simply because they have too much debt already and they just can't do it.